In this week's video, we'll review the charts to help us answer the question, is a 1929 or 1987-like stock market crash imminent? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. Given the emotional strain associated with these two periods, most investors clearly remember that prior to the peak in 2000, stocks went up a lot, and prior to the peak in the S&P 500 in October of 2007, stocks went up a lot, and in both cases, devastating crashes came next. According to the Harvard Business Review, we can be overly influenced by dramatic events. A dramatic or traumatic event in your own life can distort your thinking. Again, from the Harvard Business Review. To minimize the distortion caused by variations in recallability, get actual statistics whenever possible. Try not to be guided in the present day by impressions of the past. Since these events are associated with painful memories, it's very easy to understand in the present day that many are thinking, once again, stocks have gone up a lot. And our painful memories tell us that when stocks go up a lot, typically a crash follows. Therefore, since we have two emotionally charged events related to the stock market in our relatively short-term rearview mirror, in 2017, in order to minimize the distortion, we should look at actual statistics or facts. And that's exactly what we're going to do in this video. We'll be using a technical indicator known as ADX. ADX will allow us objectively to compare the present day to past periods, including 1929 and 1987. This is the formal description from StockCharts.com on ADX. We've modified it here to make it a little bit easier for educational purposes. Black ADX measures trend strength without regard to trend direction. The other two indicators, green and red, complement black ADX by defining trend direction. Used together, chartists can determine both the direction and strength of the trend. Before we shift gears to 1987 and 1929, let's examine this chart to better understand ADX. Wilder, who created ADX, suggests that a strong trend is present when black ADX is above 25 and no trend is present when below 20. Therefore, in this illustrative example here, ADX at this point, January 31st, 1995, was at 16.93. According to Wilder, that tells us we have a sleepy or trendless market. Since we have better data for the Dow Jones Industrial Average when we go as far back as October of 1929, we'll shift gears here and use the Dow. The math is the same for the Dow as it would be for the S&P 500 or the NASDAQ in the present day. We do have some similarities in October of 1929 to the present day. Like the present day, we had a multiple year consolidation in stocks. We had a bullish breakout, and then we could have said at this point that stocks have gone up a lot. How could an objective indicator like ADX possibly have helped us on October 2nd, 1929? From the book, Trading for a Living, when black ADX rallies above both green and red, when black ADX rallies above both green and red, it identifies an overheated market. When black turns down while above both green and red, it shows the major trend has stumbled. As of October 2nd, 1929, black had not yet turned down. ADX, especially on longer term charts, such as a monthly chart, helps us better understand what type of market we are in. It is not necessarily a timing tool to be used in isolation. On October 2nd, 1929, ADX basically would have told us we have an extended market and we should probably pay closer attention to our other indicators and our other timing tools, because as we all know, when a market is extended, it tends to be more vulnerable. If we fast forward one day from October 2nd, 1929 to October 3rd, 1929, in the small chart here on the left side of your screen, this is the day when ADX started to show some vulnerability. On October 2nd, 1929, ADX was at 62. A day later, on October 3rd, it had dropped to 61. And if we're using ADX as a pay closer attention indicator from trading for a living, when black ADX turns down while above both green and red, it shows the major trend has stumbled. So when black ADX starts to fall on October 3rd, 1929, now it's telling us that we had a we better pay closer attention market that's extended, and now the major trend may be starting to stumble, telling us to pay closer attention to shorter term indicators and have contingency plans in place in the event that this setup turns into something ugly. Well, after black ADX started to turn down in October of 1929, really bad things happened out of the very extended market profile. We could see this, measure it, and put it in a model before really bad things happened. Since we have better data in 1987, let's switch back to the S&P 500. The numbers, concepts, and principles are exactly the same. October 1st, 1987, we could have said stocks have gone up a lot. And much like October of 1929, in early October 1987, when black rallies above both green and red, ADX black clearly above both green and red, it identifies an overheated market. So once again, ADX is telling us we have an overheated or vulnerable market. It's not telling us to sell here, and we wouldn't be using ADX in isolation as a timing tool. Again, it's just telling us to pay closer attention. This chart here is October 1st, 1987, with ADX trading at 60. If we fast forward to October 12th, 1987, and this is still well before Black Monday, we can see ADX has started to drop from a mathematical perspective. On October 1st, it's at 60. On October 12th, ADX has dropped to 59.83. Now we have an extended market that may be starting to stumble. And if you know your market history, you know that the month of October 1987 was an ugly month. If we fast forward to the last trading day of the month, which was October 30th, we can see the S&P 500 lost 21.77% in the month of October in 1987. And this is the print. This is what ADX would have looked like at the end of October. We can see it's starting to fall here. Black ADX turned down while above both green and red. Therefore, in the present day, since we know we can be overly influenced by these type of events that are still relatively fresh in our minds, in order to minimize the distortion in the present day, we should get actual statistics whenever possible. Thankfully, ADX can help us ask the question, how extended is the present day trend, objectively, relative to the trend in early October 1987, and relative to the highly extended, we can see this, measure it, and put it in a model trend that was present in early October 1929. Therefore, in the present day, what we do not want to see We do not want to see monthly black ADX above green and red. And more importantly, we do not want to see ADX turn down when above green and red. Present day, we don't want to see ADX black that is above green and red turn down. We'd also prefer that ADX black be at lower levels and not up here at these overly extended levels like they were in 1929 and 1987. If we use the exact same ADX indicator on the exact same monthly chart, and we look at the reading on December 30th, 2016, we see this doesn't look anything like this, and this doesn't look anything like this. In fact, remember earlier in the video, the creator of ADX told us that no trend is present when black ADX is below 20. So we have a trendless, sleepy market at the end of 2016. Now, we all know that we've rallied since then. So has this chart here morphed into something concerning like this or something concerning like this? The answer is no. We're looking at the exact same chart on September 21st, 2017. Black ADX is at 25, which is nowhere near the overheated reading of 60 in 1987 before Black Monday, nor is it anything like the overheated reading of 60 that occurred before this massive plunge in the Dow Jones Industrial Average. Since we know September 2017 really doesn't look anything like this period in 1929, nor does it look anything like this period in 1987, how does the present day compare to the setups that were in place in late 1994 or early 1995? The setup that was in place last year, December 30th, 2016, looks very, very similar to the low reading that we had in ADX in 1995. December 30th doesn't really look anything like a reading of 60, but it does look similar to a reading like 16.93 that we had in late 1994, early 1995. And after this setup here, so this is the early stages of 1995, stocks did well for a long period of time. This is the setup, and this is what happened immediately following this setup. This was the setup last year, and immediately following this setup, similar to 1995, good things happened. And in terms of how extended the present day trend is, we're just now reaching 25. The creator of ADX told us a strong trend is present above 25. So according to the creator of ADX, we're still in the early stages, potentially, of a long-term trend. Just now are we moving out of sleepy range and into a strong trend relative to the definition of ADX. Since we know the setup that we had late last year was similar to the setup that was in place early in 1995, the logical question is, if December of 2016 looks similar to January of 1995 and ADX in the present day has risen to 25, what happened in 1995 after ADX rose to 25? This is the setup, what happened after it looked like the present day. In order to answer that question, first we need to find out when ADX hit 25. On June 1st, 1995, black ADX exceeded 25 with a reading of 26.2. We can make an argument that this is very, very similar to this here. What happened next in this case? The answer is very good things happened for a long period of time. This is June 1st, 1995, the day we had a similar setup to September 21st, 2017. Our point A is here, our point B is here. After a similar setup, and after the early stages of a strong trend here, the S&P rallied for an additional 5 years and tacked on an additional 187%. The facts that we have in hand as of September 21st, 2017, objective mathematical facts, tell us that the present day looks more like June 1st, 1995, and really doesn't look anything like 1929 or October of 1987. Does this analysis and the facts that we have in hand today tell us that the probability of a 1929 or 1987 type event in the present day is zero? Absolutely, positively, no. The probability of bad things happening is never zero. However, the facts that we have in hand do tell us that the probability of a crash type event similar to 1929 or 1987 is relatively low. Present day, the probability of good things happening is higher than the probability of bad things happening. We've been looking at monthly charts. What about shorter term time frames relative to the stock market's health late in September 2017? These are generic and, for illustrative purposes, only simple moving averages ranging from the 100-day all the way out to the 290-day. We know from past videos that a bearish bias look on the right side of these charts is quite a bit different than a bullish bias look on the left side of the charts. We can see this deterioration starting to take place, measure it, and put it in a model before really bad things happen. Therefore, in the present day, this is 2017, it's the same moving averages here in June of this year. In the present day, in September of 2017, you may be saying, what about Fed policy? What about valuations? What about the VIX, North Korea, interest rates, inflation, politics? Anything that we can possibly think of, any concern, is being considered by the market. And if it's relevant, the market's profile will start to roll over and morph into something like this. Therefore, in the present day, if any of these things or anything that we can think of is a problem, we would expect the present day chart, this is in June, when we look out in September, we would expect this look to be morphing into something like this or this, because the present day market has thought of every single possible concern from every single angle or time frame that we can conceive. How do the exact same moving averages look in September of 2017? The answer is, on September 21st, 2017, this looks like an ongoing and existing and strong and sustainable bullish trend. And it really doesn't look anything like these low probability points that we want to avoid. If we pay attention with a flexible, unbiased, and open mind, and any of the concerns that we have in the present day become a problem, it will be reflected in the charts. Under our approach, we take it day by day and we ask, based on the information, the facts, not fear or not anticipation of what might happen. Based on the facts, are we allocated properly today? If the answer is yes or we're not sure, leave it alone. We'll wake up tomorrow and go through the same flow chart telling us if any of this becomes a problem and adjustments are needed. The facts that we have in hand will enable us to make those adjustments. It's pretty clear to see that September 21st, 2017 really doesn't look anything like this, and it doesn't look anything like this. How does September 2017 compare to sustainable and long-term bullish trends? The answer is very favorably. This looks a lot more like this period here. This looks a lot more like this period here. After this, after we could see it, measure it, and put it in a model, the S&P 500 gained an additional 156%. After we could see this, measure it, put it in a model, no forecasting necessary, the S&P 500 tacked on an additional 26%. The historical charts, in retrospect, always look easy because we're stripping out all of the common missteps. When we look at a historical chart, Our money, egos, emotions, etc., they are not involved. In the present day, all of it's back in the equation. We have to keep in mind 365 days a year, no matter what the market's profile, we can always, without exception, make a scary list of things to be concerned about. And making a scary list of things to be concerned about greatly increases the odds of falling prey to one of these missteps. Therefore, as we head into next week, we will maintain that always flexible, unbiased, and open mind, knowing it's the only way that we can interpret the charts when our bullish bias inevitably at some point, whether it's 3 days from now, 3 months from now, or 3 years from now, or even 10 years from now, rolls over into something like this or this. How do we track all of this and convert it into a usable and actionable format in a reasonable amount of time? The submodels, we answer binary questions, some of them manually done, some of them programmed in Excel, and we also enter in unbiased and hard data. The submodels allow us to get a handle on the market's current profile, and the master CCM market model then looks at the current profile, compares it to past profiles, and recommends a prudent allocation between risk assets such as stocks and conservative assets such as bonds. Conservative assets can consist of cash, bonds, currencies, or any number of investment options. If you'd like to learn more about the market model or our money management services, you can visit our website, follow along on Twitter, Facebook, read our blog Short Takes, or watch past videos on the Shavaco Capital channel on YouTube. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.